Welcome to the MLO show. We got a special little episode today. Actually, super exciting. I'm your host, Casey Carpenter. You're listening to the Modern Loan Officer MLO podcast. And today we're going to have on one of our non-QM lenders, actually a close friend of mine as well, Josh Jensen. And Josh is first time in the studio for sure, right?
For sure it is.
Yeah.
Thank you for having me.
Absolutely, man. We're happy to have you. And really, it's something important I wanted to bring on for, our consumers that listen, our industry peeps that are on the show as well, because everybody does typically kind of think of like home loans, getting a home loan, like, well, there's only a couple loans out there, right? You hear that, right?
Yeah, no,
like,
you hear it all the time.
A person's like, well, there's just an FHA or conventional loan, right, to do? And you're like, majority of loans done are an FHA or conventional loan.
Absolutely.
Yes, but there's actually a whole other world or option out there of loans.
Yeah.
And so today we just wanted to kind of bring that to light. We wanted to break down some stuff and give you guys kind of some information on, hey, these non-QM, or what I like to call too, like some alternative loan options that you can do that still allow you to get home financing and purchase a home or investment or refinance and stuff like that. To get things going, though, I want to interview kind of Josh a little bit, give you guys a background of him. So take the stage, Josh. Tell me a little bit, kind of when did you get into the lending business?
Oh, man. You're going to date me now.
Yeah, buddy. We like it. We got, ages all over.
I did my internship at Wells Fargo Home Mortgage in Minneapolis, Minnesota in 2001.
Okay.
So I have been in and out of this. I have seen every roller coaster. I like the rides. I put my hands in the air like I just don't care. I started out just answering phones, and I would pass hot leads on to loan officers. And then from there, I worked for an alternative lending bank called Greenpoint. That was back in like 2003. I should back up. I moved to Los Angeles, and that was like my first.
So, but you were Minnesota, you said, to begin, and then went to LA. Okay.
Yeah.
Grab that mic a little bit, pull it close just a little bit. And now, so what made you want to get into the mortgage business?
I was just looking for a job, and I've always been, proficient with numbers, and I always liked the idea of buying and selling homes. When you're little, you look up to these people who, they make money, they drive nice cars, and I'm like, oh my God, I want to be like this guy. And little did I know how much actually goes into that paycheck, and you definitely earn it. And especially in this industry, if you're not making money, it's too high stress.
100%. And I like that you went into that. I think that's probably an appealing factor that most of us have for getting into real estate. Even with my first experience, I just finished my finance degree at Portland State University here in Oregon, and went Navy right into school. So I didn't really know much. I knew, a professional career of military and school.
I honestly didn't know that people took a mortgage out when I first started in this business. I was like, so they have to have $500,000 to buy this house? Like, I had no idea that it was financing that allows you to do this. Like, obviously you have to have your down payment, but I honestly thought you came out of pocket the whole damn thing.
Yeah, I went in super green as well. Knew nothing about it. Because for finance, degree that I got, knew about mortgage-backed securities and stuff like that, but really from stock and trading side of that. Mm-hmm. Not like the ground roots of hedge funds and not like that ground root of a home loan. And I just remember interviewing a bunch of different companies, right? You're looking at being an appraiser, being a commercial appraiser, stock analyst, financial advisor, you name it, the finance realm. But I walked in this office, mortgage company, and it was early in the morning, the phones are going crazy, people are talking,
it's like
papers,
boiler room.
Yeah, papers fly in, and then you can hear quote unquote maybe a cocktail glass in the background shaking, and I was just like, oh my gosh, this is like the Wolf of Wall Street.
It exactly.
And this was back in 2015 when I first got in the business. And honestly, that kind of energy is what sucked me in because I really didn't know what I was getting into in any type of finance career.
I don't think you can prepare for this career. I don't think you can prepare for mortgage, the highs, the lows, how much you kind of have to do mental gymnastics every day. And just to, okay, so you start at at this point, and this is the road we're going down for this loan. And then you're like, oh, skirt. Like, oh, actually, we have to take a left and then take a right to try and get this loan funded. So it's really, it's a fun industry. It's really the only thing I've ever been good at, like as far as a career goes. And so I'm always I always like hearing people's stories and just hearing like, how did you get into this? What made you continue to be in this? Because there was a lot of people who kind of exited the industry, even the first time around in 2008.
Right.
There was a lot of people who were like, this is for the birds. We can't do stated income anymore. It's too hard. And it became like kind of a feast or famine. And, with this industry, the longer that you're in it, the easier it gets.
I do believe like there is that time in the industry that can really help you be successful at it, because and kudos to people that come in this industry and honestly start crushing it out of the gate. Like, I'm always happy for them, but in a real estate transaction, there's so many things that go into it, so many different hurdles. I'm coming up 10, 11 years in this business and learn something new every day. I just had a transaction the other day where it's like the buyers is kind of showing up to properties and moving things, and we're not closed yet. And I was like, I've never had that happen before, where the sellers walk out and like, he's having a barbecue.
He's mowing the lawn.
And I was like, oh, it's something new every day. But it allows you guys out there to like have these options, and that's what's most important, I think, that I like about this career, is being able to navigate and find that stuff, right? Because not everybody's the same. And that's going to lead us in kind of these non-QM stuff we're talking about, guys. But I make the joke all the time. You can take two nurses, right? Same exact profession, and them have be completely different qualifying details for each of them, right? Because
Absolutely.
why? We're human beings. And we're different. And like financing's like DNA. Like, everybody.
No two loans are the same.
No two loans are the same. And it really, though, it makes this job interesting. I think it sucks me in the most. Like, I always make a saying, Goonies never die.
Yeah,
like, there's a way to find a way to get that client the loan and the different details. You just have to do that navigation and research. Now, we did talk about this career. This career, I think, sometimes gets a lot of glam thrown at it, also a lot of negativity. There's ups, there's downs. Sometimes they think we're all just making so much money, we don't deserve that. They also think sometimes we let a lot of money go to our head. I do believe, like you said, these ups and downs in markets weed out a lot of your negative, industry peers. Some people are in it only for stuff.
I think we're definitely at that point as well, where it's you've seen a nice chunk of people exit the business in the last like 12, 24 months. Some people are like, this is just too hard. We don't know what's coming down. What's going to change? You have a new president now, so how's that going to affect things? How is dismantling the CFPB going to be? Like, there's a lot of stuff on the plate that I don't get nervous about stuff like that. I'm kind of like, it kind of is what it is, and if you can't control it, you shouldn't waste your time or your energy on it. And this is something, with the new president and everything, that you really can't control.
Yeah. I mean, our business is industry-based and economic-based, right? So the way presidential elections change sometimes affect our business. I mean, a lot of that stuff is out of our hands. And I think you're now seeing your good advisors, your good agents, your good loan officers, and all that stuff come through because we've been there that whole time giving that solid advice. We're not just based here for cheap stuff. Though, I like to touch on this because we're kind of getting into the backstory for Josh. With these ups and downs, like, how's that been for you, for your career? Does that put stress on your family? How does the wife take that? Like, this is something that people don't actually ask a lot or get into it because this business has highs and lows. And,
it's, I have worked like a 17-hour day before and still left work to be finished the following morning. And it does stress you out quite a bit, but there's also some immense level of satisfaction that you get from closing the hard loan, from being the hero. You don't really find that in any other aspects of your life. At least I don't. And my wife, God bless her heart, she is always, I keep having this running joke, $5 million. If I can close $5 million for 6 months, she can quit her job and just be a stay-at-home mom. And
Yeah.
so, you know,
We're talking $5 million a month for 6 months.
Yeah. But I won't say yes to that until I have a track record of 6 months of doing it.
Yeah.
You know, because then I can afford the things that my family needs to, you know, maintain the lifestyle that we've created.
Yeah.
But it's kind of a little nerve-wracking. Like, I just had a child.
Yeah.
So,
yeah, you did. And congratulations,
thank you,
right?
sir.
That's first baby?
Yeah, first baby.
Yeah, absolutely.
Josephine June Jensen. Big shout out, baby.
Shout out. Hey, I brought my kids on here before. Yeah, we're all about it.
Yeah. So I have like a whole new perspective now too. Whereas I used to think that a loan kind of going sideways was the end of the world. And now I have a greater perspective on that, where if something was to happen to my child, that would be the end of the world. Something to happen to my wife, that would be the end of the world.
Yep.
But a loan going sideways, like, there's always a way, not to walk it back, but to maybe take another turn. Or even I have a really good boss, Shane Nielsen, that I always, know him as well. Shout out Shane. I always run stuff by him, and I'll say, hey man, you know, I'm stuck. I'm looking at this and I feel like I'm getting tunnel vision. You know, and when you get tunnel vision, you think there's only one solution.
Right.
But non-QM offers so many different solutions that, you know, if it doesn't work out one way, like say you start with a bank statement loan, and then like they have a ton of NSFs. You're like, oh my God, what am I going to do?
Yeah.
You know, but maybe it happened 10 months ago. That's when you pivot to, like, say, a 1099 loan. We're just going to look at your 1099s. We're going to give it a little reasonable expense factor. Bada boom, bada bang. We don't worry about those NSFs anymore.
Yeah, no, I agree. And I think that's a good transition for us to roll into kind of what we're talking about today. So non-QM loans. Do you want to explain just in a basic form what a non-QM loan is?
Yeah.
And kind of why they were made?
Non-QM loans are basically alternative income. So we're not going to require tax returns. There's bank statement loans. There's CPA gross receipts. There's P&L. There's also a DSCR loan, which is a business purpose loan. So it doesn't follow TRID.
Okay.
You know, so you don't have like these rescissions. They're still going to be beholden to QM points and fees. But in non-QM, you can go up to 5%. Whereas, like, your traditional loans, you're looking at 3% points and fees.
Gotcha.
And then also with your debt to income, I don't play an A paper at all, so forgive my me not knowing. But I think DTI is probably like around 43, right?
Yeah, 43, 50 on some stuff. Yeah.
Okay, yeah. And so non-QM is typically going to be 50. In some instances, you could get 55, but it has to be like a super clean file. You know, certain nuances that you need to do with it.
Yeah. And so kind of with that, you know, listening out there, so non-QM, you know, the way I like to present it with clients is they're an alternative way for us to look at your income for qualifying or different features on the loan. This isn't like some kind of, you know, dirty loan out there, something nasty hidden around the corner that you're doing. These are essentially conventional loans for the most part, alternative ways for you to look at the income. There's also FHA options and some VAs out there. But it helps your clients have a means to get qualified. Let's start with kind of some different loans that are out there. And Josh touched on a bunch, but kind of out of the gate would be, I think, a really known one, or if you haven't, it's a bank statement loan. And they're like, oh my gosh, I think they relate that to like no income, like bad, you know.
Stated income, stated assets, stated
It has
everything.
nothing to do with any of those loans from 2008 that were a little wild and got everybody into trouble. So what it is typically on a self-employed borrower that we have, traditionally for your normal loans, you're going to look at tax returns to try to get their income. A lot of times, self-employed borrowers, bless their heart, write everything off on their tax returns. They like to put everything in expenses, and usually those tax returns just don't show very much income. Well, how else would we get income then for the borrower? Well, we could look at a non-QM bank statement loan option for them, where they're going to take the bank statements, 12 or 24 months, and look at
business or personal,
which is big time, and look at deposits. And so from there, there'll be a haircut to that calculation.
Yep, 50% is going to be your base.
Okay.
You can go as low as 10. If you're going to go below 50%, you have to have a CPA on board who's going to attest to them operating at the lower expense factor.
Yep. What that means, guys, is like 100% of that money we're seeing as deposits. Let's just say
Yeah.
that's 100 grand. 50% of that would be 50 grand that can be used, right?
Also, they have to be business deposits. It can't
Correct.
be Casey sold his Ferrari,
Yeah.
and now we're only going to give him 160,000 of that 320,000 car.
Yep. And the reason these are nice is because a lot of times that shows enough income for the borrower to qualify. So you have a self-employed borrower who's been told he can't qualify for a loan, but there actually are options for him. Now, some other caveats or other options for that would be maybe a P&L statement loan, which they're going to use the P&L. Obviously, I think that has to be attested by
Yep,
a
a
CPA,
CPA
correct?
as well.
Or financial tax person, right? But what it is it's allowing you to have other options to get qualified rather than your traditional. So that bank statement's a really good one.
Can I just interrupt you for 1
absolutely.
second? The 1099 is my favorite one.
Okay.
The
good
1099 loan, you're going to get your 1099. You're going to take 90% of it and divide by 12.
Straightforward as that, huh?
Yeah, and I mean you can do it with borrowers who were a W-2 and they transitioned to 1099, and then we can consider that full doc.
Like we're a borrower too, kind of your standard employer, and then went to a 1099 for 1 year, or do you have a
They're going to have to start as a W-2 and then go to a 1099. But
same profession?
Yeah, same profession.
Okay.
But they're really going to have no outside expenses. So it's going to be, if you were a painter, they're going to give you the painting supplies. They're going to give you, there are certain things like you're going to have no matter what, like a car or something like that. But as long as they're not coming out of pocket for expenses, we're going to use that 1099.
Yeah, and so with that kind of rule there, guys, just to be aware, as let's just say you're a painter working for Miller Paint, W-2 employee, and then you started your own paint business, well, you're now self-employed. A lot of times we need to see now you've been self-employed, 2 years of self-employment, tax returns and schedules and all that stuff, where you are receiving 1099s because you might be subcontracting for work and stuff like that. What Josh is saying is you can use the 1099s for qualifying.
Yeah, it's at the end of the day, people are always pleasantly surprised with how much income that they end up getting.
Yeah. I think that's the most important part is I've really yet to do one of these options, and I do them a lot for clients. I really do because they're a very, very well useful tool and loan to do for self-employed. But I rarely have that come back with
Less than you thought.
Yeah, less than I thought, or income we can't use to qualify. And also, again, like we mentioned, guys, if it wasn't enough, a CPA can attest, and you can get more income because a CPA can state that, yes, the expense factor is only 25%.
They do have to have reviewed their taxes, though, too. They have to be the guy who prepared those taxes.
Yep, absolutely. Great comment. Got to be your CPA that knows your stuff. But it's a way to get options. So if you're self-employed out there, even if you're 1099, people in our industry, right?
Realtors, we're looking at you, realtors.
It's a way to get qualified. Don't be, everyone says, well, I don't show money on tax returns. Well, guess what? We have other ways. Oh, there it is.
Oh, I'm so sorry.
You got it. We did the podcast rules. Cell phones vibrate.
I did it.
All good. We're let's transition though over to talking about like jumbos real quick because we are seeing higher priced homes in the market and stuff, and so jumbos are going to be loans above your max conventional loan limit. I believe over here we're around $806,500, and so any loan amount above that's considered jumbo financing. We used to see this be super competitive in the big bank areas, kind of the last 7 years ago, 5 years ago. Now you've seen a lot more lenders come out and be involved on this. It does allow us to give those clients more options and stuff like that. And so jumbo is now kind of, still a product out there, but in the non-QM world, we have multiple options to look at for clients. Anything cool on that?
Yeah, so a lot of our jumbos are tied to AUS. And so AUS is an automated underwriting system. We're going to look at those findings to determine what the assets you need. Are you going to need housing history? It's very cut and dry, jumbos are with us. It's kind of like either you fit in this box or you don't. Yeah. And that's just for our Jumbo A paper product.
Okay.
We can do jumbos on non-QM as well.
Nice.
So, you need a 2.5, a $3 million loan. Go ahead. Don't think that we can't do it just because it's non-QM. So, yeah, the jumbos they're really hot right now, especially our Biscayne product. We have just super killer pricing on it. You're going to compete with banks. You're going to compete with credit unions. Like, you can bring this to Casey. You do not have to go to your credit union. And chances are our rate could potentially beat it.
Yeah. So you hear that out there, my lender industry peeps listening to the podcast. Don't sit there and boo-hoo yourself because you don't have options to compete with those banks.
Yeah, I mean, I think that's like kind of a misconception in this industry right now. It's like, oh, they brought it to a credit union, and the credit union's going to give them whatever they want. They're barely going to have to write anything down. But, a lot of the times, sometimes you need something done fast,
right,
too. Have you ever tried to get something done at a credit union before?
I did a little dirty stint there, and I learned a lot. So you're not here on this podcast to
No. I'm not
on anything, on big banks, credit unions.
SharePoint Credit Union, I still love you.
Institution has their need and their benefit, and we're for origination at all levels. But I did work at Wells Fargo for 2.5 years. I know how
Wells Fargo team.
Yeah, Wells Fargo go. I know how that operates, and it's just a different world of loans.
Absolutely.
And that's all it is. And I think banks and credit unions are very good at the things that they choose and focus on to be good at. But there is a wide base of consumers out there that need help, and not everyone has perfect credit, large down payments, and just a paper.
Right.
Your main regular consumer usually has maybe a lower credit score, doesn't have enough money saved up, isn't showing enough money on tax returns.
Or has a late
payment or some kind of issue. And that's why I always have chosen and love being at a mortgage company and having broker options, so I can hook up with Don QM and I can help, like I said, almost anyone that I come in contact with.
I don't think there's a borrower that I wouldn't refer to you, to be honest with you.
Yeah.
Well, I mean, I really
Appreciate
like
that.
you as a loan officer,
Yeah, thank you.
but also I think that you, especially Mortgage Express, you have so many different outlets.
I agree.
That, even if I can't get it done, I'm sure one of my peers can get it done. It's never like a firm denial.
Yeah. And that's what we strive for. I mean, here we try to make sure we can help out all of our consumers. All right, so let's kind of roll into for my investor clients out there, so people buying investment properties for looking to own multiple properties. Let's talk DSCR loans.
Let's go.
What is a DSCR loan? See, I actually ask agents this all the time. A lot of people don't even know.
DSCR, non-trid loan. Debt service coverage ratio.
So that's what it stands for?
So what that means is you have your principal, insurance, taxes, PITI, sometimes A, which is homeowners association, versus what you get in rent. So, you have $2,000 in rent. You want that payment to be $2,000. That would be considered like a 1-to-1 ratio.
Yeah. So tell me this, though. So DSCR, though, this allows someone to buy an investment property, correct?
Correct, yep.
And then buy the investment property based off of just their credit score.
How it cash flows.
And then how that property cash flows specifically, correct? So correct. Meaning rent's coming in versus expenses.
Right.
And then that ratio tells you the cash flow of the property, and DSCR allows for that ratio to be...
With us, you can go down to 0.8.
Okay. Which would be negative cash flow, correct?
Correct.
Because one would be you receive $2,000, your expenses are $2,000, right?
Right. Okay. Right. So sometimes people fall in love with an investment. Maybe it's a great area. Okay. Maybe you have a vision for the property. That would be the cases that you'd go below a 1. So, it has really good bones. I'm going to put an ADU in the back. I'm going to do this, that, and the other.
Future potential is there.
Yeah. You're not really looking for it to cash flow
out of
immediately.
The gate. Okay.
Correct. But, if you have a vision and you're willing to, skin in the game on it, then potentially you could have a DSCR cash flowing way greater once you're done.
Gotcha. Yeah. And with that then, guys, because a lot of people are like, well, they don't have... the income or whatnot to qualify and that kind of thing. You have to consider DSCR as that option of looking at buying investment properties. What's kind of down payment on those?
Down payment, you're going to look at 20%. We also, sometimes we can base it on short-term rents if they are an experienced investor. but you would have to put 25%. And that, I'll touch on this real quick. So we have a system called AirDNA, which will pull in Airbnb, VRBOs, and it will give you the average short-term rents.
Okay. If it's a short-term rental or being used, is that?
Correct. Yeah.
Gotcha. Yeah.
And basically what we can do is if you're at 75% or less and you're a seasoned investor, which is defined as owning a property for at least a year within 36 months, an investment property, I should clarify that.
Okay.
Then you have the ability to have that report come in, and it can supersede the 1007, which is the rent schedule, which is what the appraiser provides as what he's going to deem to be your market rents.
Gotcha.
They're easy loans.
I like these a lot. I actually helped clients, some of my real estate agent partners had some investment properties over in Wichita, Kansas.
I remember those.
Yep. And, we use this for an ability to refinance them and get them out of their private money, hard money loan that they used to buy the properties originally and put them into a long-term fixed product, which was the DSCR loan, and they were rental properties, investment properties, so they had their rental income. We were able to do it, and for them, it was a great option to get them out of current loans into a fixed loan. And I think for someone that's looking to take that next step, you should highly consider it. Now,
There's no income, so let's be clear, no income at all.
So just to be clear to the bar or to all of our listeners out there, from the borrower's standpoint, what are they needing to bring to the table?
You got to bring your money.
Down payment.
You're gonna have to have credit.
Yep.
Established credit history.
Minimum credit scores?
I want to say minimum credit score is 660.
Okay. So
that's just off the top of my head.
Average credit.
Guidelines change all the time. Don't hold me to it.
Yep. Nope. We always have to throw our disclaimers in there. They're not CPA or certified.
Right.
But okay. So we have to have credit established.
Yeah, you have credit established. You have your down payment. You have reserves that you're going to need as well.
Reserves are going to be money that are in your bank accounts. Seasoned that we are not using for the transaction. So in checking, savings, investment, retirement accounts, things like that.
Yeah, it cannot be, I think it's like an employer contributed 401k. You can't use that one because it's got to be a business purpose loan. So we're not using any finances that are going to be like tied to your persons.
Makes sense. Also, though, FYI, my loan officer's listening to the podcast as well. That's how I was able to do a DSCR refinance in Wichita, Kansas, because it's a business purpose loan.
Well, and there's another neat thing is, there's some states that you don't have to be licensed in that state.
Yeah, that was this one for me.
Yeah, there's more than a handful now, and I think they're opening the door to more as well.
Yeah, you're seeing that.
So, if say someone here is like, oh, I really want to buy this property in Florida. I can't, I'm going to retire there eventually. I'd like to, you can build little pockets of real estate. So, you say you're watching some sort of news network and they say oh, this is where a new fulfillment center for Amazon is going and it's in Toledo. And you're like, oh my God, I think that I should buy a duplex there. So you kind of can match up where you think the hot real estate markets are with, do I need a license to originate in that state?
Oh, that's smart. Yeah, it's a good way to start thinking of business. Any other thing on DSCR before we leave it?
I really like the product.
Is there
There's prepayment penalties?
Okay.
You can go no prepayment penalty, but I will caution you the rate's going to be higher.
So they have options. That's a good point.
All the way up to 5 years.
Gotcha. When you're doing those loans, you'll select your option for a prepayment penalty, meaning that loan cannot be paid off within 3 or 5 years or whatever you choose, without there being a prepayment penalty associated. And then last part is units. Is there size, property, number of units, caps?
We can do 1 to 4 units.
Okay.
There are other lenders out there that will go all the way to 8.
Okay. So you can do kind of some multi-unit.
You get into
options.
some mixed use. Some lenders do kind of a mixed use product. I don't see it a lot, and I've worked for other lenders before, and to tell you the truth, they're kind of far and few between.
Yeah. But hey, if you're out there, there's still options for you.
Absolutely.
Basically with that. And they're all, broker options as well. I know with us here, there's other lenders and stuff that we have that look at commercial type properties or mixed use. Everyone's got kind of their niches. That's what's the beauty about having, broker options and trying, for me as an advisor, put the client in that product that fits them or that we need. So that's a beauty about that stuff. All right, and then let's roll in for one that is kind of just coming back around in conversation. I'm having it recently a lot with clients, and that's a bridge loan. A bridge loan for us is a way to allow a client who owns a property and is looking to buy another one, but all of their money is tied up in the equity of the home. Well, it's the day old, aged question always, like, I don't want to sell my house, but how do I access that equity in the home to buy?
Yeah.
Home equity line of credits are one option. We've talked about that a lot on this podcast. But one that's coming back around is a bridge loan, where a lender will leverage that equity portion that you have in your home, giving you financing up front to purchase. It allows you to be non-contingent on your purchase, which is fantastic. So you'd buy your new home that you want with your bridge loan, and then you could turn around and then take your time you needed to sell your property and then come back and apply that's your loan how you want. Some of them allow you to pay it off completely too. So a bridge loan is kind of another option to bridge the gap for buying now and selling afterwards is what it is.
Yeah, we'll do the takeout for those.
Yep.
So at the end, you've got your bridge loan, you've made all your remodels and everything. We can do that, and you can also take delayed financing.
Oh, yeah.
On that, and so, we can basically get you your money back.
Yeah, do like a cash out refi delayed financing on it.
Exactly.
Yeah. And with those options, it's another tool for a client out there, just because sometimes we're seeing contingent offers have a little bit more pushback. So contingent meaning you have a house to sell that you need to sell in order to buy. This is a way to kind of go around that and be non-contingent. I like it as another option. Those really, guys, for me are some just go-to non-QM loan options. Some other ones that I will just mention out there are down payment assistance loans. So these are loans that'll give a home buyer the down payment, and those are great options to have. So if you're looking at as first-time home buyer or just you're not, but you don't have the down payment assistance loans are a good non-QM option out there. I just did a scenario with a client where they have just lower credit scores in the mid 500 range, and they've had some missed payments on their mortgage and credit card in the last couple months and 24 months. So that one's a little bit more of a rougher loan to look at, but the beauty of it is there's options out there that allow for refinances down to 500 credit score and 550, and you have certain requirements for them.
It's typically a little bit more tricky to do it if it's like a mortgage late.
Yeah.
Consumer lates, no one really cares about. We don't care about consumer lates.
Yep.
It's not really that big of a deal because your credit score always reflects that anyway, so you kind of take that in account when you're looking at the credit report.
Yeah, good point. But the mortgage rates are important, and it's typically, a mortgage rate, and I'll explain that for a client, is your payment's due on the 1st, and you have till the 15th to make it. After the 15th of the month, you get assessed fee, but that is not considered a late payment yet. It is not late until it is 30 days past the due date, and that's when your lender will report that to the credit bureaus, and that's where it's a hard hit to your credit score, meaning there is a little asterisk remark over there of Casey Carpenter with 30-day late payment
Slap on that hand.
March of 2025, and it stays on there.
Correct.
And it can be a 100-point drop in your credit score sometimes. It's a big hit. So try to avoid those if at all possible. If that does come up, though, there are some loan options out there that allow for it, but there's only a certain amount that you can do. They have requirements of how many can be on there.
Yeah, typically for us, we'll allow like a 1 times 30 over 12
30
months.
In the last 12 months. So
Yeah.
like 1 30-day late.
Yeah.
I believe I want to say 2 out there, and don't hold me to this, but I'm close. I think this is a close guy. I think they allow for up to 2 in the past 24 months as a max.
Yeah, I think we have one product that does that. I think on our expanded, we'll do like a 2.
Yep. But again, back to the topic really of it with just another option for someone to look at for a loan that's not straightforward and traditional. let's go into kind of the last part. Is there another loan option, a DSCR or
Oh, we do a bank
non-QM?
statement closed end second.
Oh, that's kind of cool.
Yeah, so I mean, it's kind of like the rage right now, right? Like paying off debt, credit card is at like an all-time high. Everyone's got all this debt, yet we still have all this equity in all these homes. So we can do a bank statement second on a primary.
Yeah.
Wow. So yeah, I mean, you need
Bank
the money.
statement, second loan. So you can do a second loan, a HELOC, line of credit.
It's a closed end second.
Closed
so
end
it's
second.
fixed.
So it's fixed.
Because you know how on HELOCs, sometimes if you don't use it, you lose it.
Right.
They can
open
close
end
that
loan,
on
right?
you. Yeah.
So you can do a fixed close end second loan, bank statement qualifying.
Yeah.
Very cool.
Yeah. I think minimum is $150K on it.
Very cool.
And our rates are right up there. We have a CEO who really delivers on his promises for lower rates or not the lowest rates, but in that realm.
Gotcha.
And so we've been originating a ton of those now, and it's going well. You have the ability to just do a drive-by appraisal if it comes in with the right confidence score.
Wow.
And also like a limited title, so you're really dialing back a lot of those fees, so it becomes even cheaper to lend for your clients.
Wow. So kind of, do you think it's competitive with a HELOC?
Yeah, it absolutely.
Because those HELOCs you always hear.
Well, it's prime plus.
Prime plus, right?
Whatever.
And then, but like fees are usually pretty minimal.
Yeah.
On that stuff. So
Yeah, our fees are pretty minimal on those as well.
that's awesome. That's another tool. All right. So kind of rolling into, we'll kind of get towards the end of the show today, but I always like to talk about, new stuff or different stuff that's going on. So why don't you tell us, Josh, kind of some just recent loans you've closed or kind of some different deals that you've done. It's okay if it's kind of the same stuff that we've gone over.
I have a loan that I just closed where they submitted it as two parcels together, and they put the wrong address in. So when I submitted the file to underwriting, it looked like it was like a fruit orchard.
Oh, wow. Okay.
And so, we had to peel back the layers of the onion to be like, okay, where does this address relate to this? And it turned out they had never like officially recorded it as two different parcels. And so we had to go back and split it all out. But we got it done. And interestingly enough, this separate parcel, we don't lend on orchards or anything like that. Anything that's like income producing, we won't.
Right.
But once we peeled it back, they actually got a better rate, and they separated out the parcels, and it wasn't as difficult as you think. That's something that you have to remember about non-QM, not just you, but like everyone in general. It's not as hard as you think to uncover the facts or figure out the right route to go.
Yeah.
And that's why I'm always around. I pride myself at, I mean, you can testify to this. Like,
Yeah.
I really do respond pretty quickly.
Yeah, Josh
And
probably
on the
one of the best, reps that I've ever worked with for non-QM at a company. I mean, just like a real estate agent partner or something, very communicative.
We're partners.
Yeah, we're partners. I mean,
Yeah.
we're in this, right?
Yeah.
In this together. That's who I like to work with, and that's who I'm always advocating for clients to be with. I think someone that communicates, can pick up the phone when you need it, answer your questions. This is not 9 to 5 jobs, guys.
No.
This is career based. It's
yeah.
our businesses. Like, we're here to help you. What kind of loan were they trying to do on that?
They were doing a bank statement loan.
Yeah.
And also, one last thing, I do ITIN loans as well.
There we go.
Yeah, the ITIN loans, it's a really underserved community. And also...
Will you explain what that is? What's an I-10 for someone that doesn't know?
An ITIN loan is basically someone who doesn't have a Social Security number, but they still pay taxes.
Yep.
So they issue that out so people can pay taxes. They are limited in how much they'll lend. Like, there's an 80% LTV maximum, and their FICO can be 660 and above.
Gotcha. Okay.
But a lot of people don't think that they qualify in these communities. And I'm not just talking about like the Hispanic community. Like, I do ITIN loans for people from India, for people from all over.
Yeah, absolutely.
They're underserved for sure.
Underserved. So when you're out there, if you're a person that's like working on, you just came to the country, you got a visa, or you work visa or I-10 number. Don't forget about these type of options for you. Non-permanent resident, alien stuff. I mean,
they do need
certain
credit lines too.
Good point.
We're gonna look at 3 credit lines for 12 months. like a 4 for 4, or a 2 for 24 months. Like, so there are minimum.
Meaning, like, you guys have
Trade
to have,
lines.
a credit history, trade lines, accounts. You have to have, credit going.
Yeah, I mean, it's one of my favorite loans. I think I posted on LinkedIn the other day, like my grandfather was an immigrant. And he, he did everything by the books. He came through, he got everything done, but also he really wanted to try and make things accessible for my family. And so he always kept like a perfect credit history. He always kept
Yeah, good for him.
things in line. And I think that's actually why it's so near and dear to my heart at this stage in my career. Because like, I really want to see everyone own a home. Like, I honestly do. I think that is like a great thing to aspire for this country.
I agree too, and it is shown the amount of wealth that is compared to someone that doesn't own a home.
And a lot of
substantially different.
I-10 borrowers, they have a ton of mattress money typically.
Yeah,
Like,
very
usually
good.
they will have some cash and some assets in the bank.
Yeah, I feel like there's a way to get it done. So that's important. Don't forget, like, kind of what your citizenship status is or your ability here in the U.S. Like, there's options still for you to get loans on. Any other thing in the non-QM world as we wrap up the show today? Look at that. We already hit 45 minutes. I told you.
I can't believe it. It really felt like, and he told me don't look up, but I keep looking up.
That happens.
Yeah, this went way faster than I thought it would be. Thank you so much for having me on. I really appreciate the opportunity.
Yeah, absolutely. For any of our listeners and stuff like that out there, please follow us on YouTube, listen, subscribe, like on all the podcast platforms. And if you have questions about non-QM stuff, you're a self-employed borrower out there that's been told you cannot qualify for your home purchase because your tax returns.
I thought of one thing.
Do it.
Can I finish it?
Absolutely.
Okay, so you can close into LLC.
Oh, there it is. Yeah, nice.
So
nice.
DSCR, you can close into LLC. The LLC has to be for the purpose of real estate acquisition. So what you, in theory, could do is me, you, and 2 of our friends, we could start an LLC, and we could each put 5% down to acquire an investment property. So that makes the entry barrier a lot smaller.
Got you.
You know what I mean?
Yeah, okay.
And so that's a good way to kind of like, you could do it with your brothers and sisters. You could, like, that's kind of like how you can build generational wealth, is something like that. You can close it in an LLC.
Gotcha.
It's a maximum of 4 borrowers.
Okay.
Everyone's going to need to go on the loan.
Okay.
But yeah, and we're not going to take any of this income or employment into consideration in it. So it makes it like a really easy checklist to try and submit.
Going
these
off
loans.
of the lowest credit score between the
Correct.
4 borrowers?
Mm-hmm.
Okay. So if you do not have the down payment needed to purchase, or you're trying to do something together with family
Or friends.
or friends,
Anyone, like, you always hear of people say, like, oh, I really want to start investing in real estate, but, like, they don't really know how to start. And I think
and
that's
that down payment is a big hurdle.
Down payment's like the biggest hurdle.
Right.
Besides FICO. Right. Yeah.
Well, that's another option. Then keep that in mind if you're trying to get into investments. It could be a good way for you to start it up.
Absolutely.
And each kind of contribute the small amount you have, which makes that full down and rock that way. Heck yeah, throwing nuggets in there.
Yeah.
Well, yeah, guys, if you liked what you heard, please shoot us a message. If you have other stuff you want us to talk about, you know where to leave that to. You can email us to the show or reach me out directly. But until next time, we will catch you later.
Thank you.
Peace.
The MLO show is hosted by Casey Carpenter, NMLS 1458123, Addie Nett, NMLS 1542184, Michael Mealy, NMLS 963197. Not a commitment to lock or lend. Terms and restrictions apply. Not all applicants will qualify. Mortgage Express, LLC, NMLS Company ID 40831. Licensed in Arizona, Oregon, Washington, California, Idaho. With licensing in California by Department of Financial Protection and Innovation, DFPI, under the Residential Mortgage Act. Mortgage Express is an equal housing lender. For more information, visit www.nmlsconsumeraccess.org.